class. I'm just going to walk through a couple of in-class examples that we didn't really get to just to help round things out. The first one I wanted to walk through was a self-study problem, which is actually out in the um, textbook, but I wanted to walk through it and add a few different details that might be helpful for you when you are working on the homework if you are still working on that. So we've got Games Incorporated. They develop market package multimedia computer games. And they gave us here a table that tells us, okay, at these different prices, different sales volume is demanded, right? So the price of their product affects how many units of that product they're going to sell. And so because of that, I'm just going to put here um, the sale price and the sales volume. And then I'm going to put revenue here. And we're just going to do this for these different ones that they gave us and multiply these out just to get sales dollars here, right? Okay, so all right, so here's the sales we've got. Just going to multiply this out in terms of dollars. Drag that across, and I'm gonna change some formatting here so the default ends up being with thousands in here. Okay, just to make it a little bit more readable, all right? So we see here, they also gave us another table that told us where they ended up with their first year operating results, right? 1 second here. Okay, so looking through some of these other costs that they have here, it says the manufacturer of the Blu-rays charges games $9 per Blu-ray produced. So they're going to have, um, let's see, a variety of costs per unit here. So I'm just going to put, all right, so we have, oh, production of $9 each. And then packaging is going to be $5 per unit. And distribution is going to be $3 per unit. All right. So we can take these and multiply them out. I'm going to just go ahead and insert a column here, right? Now, I'm going to put this and leave that here. But for the expenses, right, we're going to put packaging. I'm just going to do like the same line items they've got below, right? So production, packaging, and I'm doing it for all of them. They did give us this one example at 44, but I want to walk through these. Okay, so distribution. All right, so then I'm going to put here then, I'm going to put those over a little bit so that I can or total variable. And then I'm going to put also a line here for contribution margin because there are, it's just handy to know that part, right? Contribution margin. And then we'll put, they've also got here advertising, fixed overhead. So advertising would be a period cost, right? So advertising has fixed and variable elements. So let's add that up here. And fixed. All right. So if we have on a per unit, so 953, the variable advertising is, let's see, one advertising expense for each $500 of expected sales. Okay, so I'll put a formula in here for that one. So here then we're just going to put the B9, whoops, B6, sorry, B6 times the C4 here. And I'm going to put dollar sign, I'm going to put C dollar sign 4, which locks in on row 4, but will, if I drag it to the right, will move it to the right. And here I'm going to lock this on to the column here so that I can drag that to the right, but I can also drag it down. Okay, so taking those two, all right, and I will test this formula. I'm going to drag this over, should be that and that. Okay, that looks good. That and that, and that and that. Okay. Let me put this in here so you can see what this formula is here. All right. Now, and now because the way I did this, I should be able to drag that down. Yep. And yep. So then I can drag it over. And so when I look at that, it's going to be doing that, right? Yeah. So taking the volume times that row's expense per unit. Okay, so I've got that. Now, the advertising variable part is $1 of advertising for each $500 of expected sales. Okay, well then let's just take here sales divided by 500, right? And we'll know if I get this right if I take that and add it up with, okay, so the fixed advertising is 1 million. And they came up with for advertising 1,148,000. Oh, let's see, so at 434,232. Let me double check that. Revenue, it was $500 of expected sales. So it should be that divided by 500, right? Okay, hold on. So the fixed is 1 million. Hopefully it keeps it there. So if I add that together, it's 1,034,000. Okay, so they're getting 148,232. Fixed overhead is projected at 2.5 million. I have my revenues right here, right? 17,116,000. All right, hold on a second here. Oh, and of course, it's because this is actual. It's not going to line up. Okay, so this is 1/500th of that, just as they directed us to do here. And then let's see here. The next, okay, so then if I take my total here for the variable costs, go back to my home here, get my sum available. All right, so in terms of variable costs, that's the amount that I'm going to end up having there. And then if I take my sales minus my variable costs, that's going to get me my contribution margin. And then for advertising, I have $1 million in fixed across the board here. And then for fixed overhead, which is administrative salaries, it's going to be 2.5 million. Okay. And then, so total fixed costs then. 3.5 million. And then operating income will be the contribution margin minus the total fixed. Okay. Okay, so these are our budgeted amounts here that I put together based on those assumptions that they had here. Now, the question they're asking here is why would they not consider selling it for any price other than $44? Well, because when we look at these variable ranges that they have here, that's obviously the one that has the highest income out of the four. So that's the one that we would want to look at. Now, they gave us this actual number here down below. And so we want to then, they want us to do a budget to actual comparison here, right? So I'm going to take this and I'm going to just copy this column down here. And if you recall in class, I did the actual, and here we could have a static budget. We're not doing a static one, so I'm just going to put the budgeted in the next column here. So our budgeted amount is right here. And I think this may, we'll do this here. I'm going to paste values here. So I've just got the values there. All right, and then in terms of actual, all right, so production. Now, the variable advertising, if we say that the advertising was $1 million, then that would mean that the advertising variable portion was 232 there, or whoops, the 148, 232. And then pulling that formula down there. And that one. All right, so, and then let's make all of these numbers with commas again. Okay. Oops. 1 million. Oh, yeah, then 25 there. So I'm just plugging in my formulas here from up above. All right, so then in terms of what actually occurred, the variance then by definition is the difference between these two, right? So I'm just going to take the actual minus they said, there's no difference here, but I'm going to do the actual minus the budgeted here. And in terms of revenue, there's no difference here. Going all the way down for these, right? So our actual, we had less packaging than what we budgeted for. So it's a lower expense. So that is going to be favorable here. Distribution was more, so unfavorable. This one was more, so again, unfavorable. And our contribution margin in total was unfavorable because our expenses were overall more than, so we look at all these variable expenses, we had $434,500 more in expenses than what we budgeted for, which is unfavorable. And then down here on fixed, we had, oops, I did not get the actual one here, 2506, 200. Oh, whoops, no, wrong one. I wanted to do that one. Sorry. There we go. So we had a difference there also. Now, notice the difference up here in our advertising ended up getting pushed into the variable portion. We just assumed that the fixed part was the same. We could have combined all those together also if we wanted to have the variable and the fixed together as one advertising line. But because I was doing a contribution margin format here, I wanted to separate the variable versus the fixed expenses. All right. So overall, our net income was less than what we budgeted for here, right? And our expenses, our fixed costs were unfavorable also. Now, one thing that you can do here when you're analyzing this is like, okay, what percent difference were we from our budget here? So in order to calculate that, we would take here the variance divided by the budget. So like if we're calculating what percentage we were off here from what we expected, we would take the um, um, variance column divided by the budgeted column. And I'm going to make that so it's got some decimal points on it. Okay, so 8% off there, right? In total, our income was about 6% off. So also, if you're looking at how something changes from one year to the next, by the way, you would take the amount that it changes between one year and the next year and divide it by the base year, which is the beginning year. So something to keep in mind for problems on the homework. Okay, so that's it for that problem. I just wanted to look at the variances and also like calculating out what a variance is in comparison to a base number. So how is this different from this budgeted year? Or we could look at like how does one budget from the next year by saying how much did the budget change from one year to the next year? Take the change amount and divide it by the earlier year to get the percentage that it has changed. All right, so that is from chapter 6. Next, I'm going to look at a couple items here from chapter 7. So before I start talking about that example, though, I did want to just go over a couple quick items from chapter 7. You can obviously read these in the textbook, but just wanted to call out like what is the process of what we're doing here. So in the previous problem where we had our budget, we had what are called overhead items. And overhead are items that we can't easily assign to a particular item, but we incur them anyway, right? So like we can't determine exactly when they occurred and how much is assigned to, say, different units of product based on like observable cost associations. So we tend to group them together into a pile of money and then allocate it out using some proration method. Okay. So first, you have to figure out, and typically what you try to figure out is like what drives an overhead cost to increase. Is it like more of a particular activity? Is it more people, more hours of work? Is it more hours of machines being operated or things like that? Um, any one of those things could be what's referred to as yeah, an allocation unit, okay, an allocation base. So we're going to say, all right, who do we want to assign costs to, and then what drives their costs, okay? So once we do that, we first figure out, okay, do we want to assign our cost to a department or a product? Then we're going to pile up all the costs that we need to distribute, and then we're going to allocate them out on a per unit basis using whatever method or process we think drives the costs to go up. Okay. And so I will go through a basic overhead calculation, and then we will talk about some different types of costs that tend to be allocated out. So we talked previously about responsibility centers like cost centers and assigning costs out based on responsibility areas. So things like marketing and distribution costs often get assigned across different cost centers. And so things like income tax typically get assigned like to actual areas based on their actual income, right? Now, So first we want to come up with an estimate of how much we think is going to be assigned and at what rate. Like what is going to drive this cost? Is it going to be, say, machine hours? Okay. We think that this utility cost is going to go up based on hours of machine usage. And so we're going to figure out how many hours of machine usage there will be. And then we're going to figure out roughly what we think the cost is going to be. And then we're going to divide out those utility costs based on those machine hours. Okay. And then we can assign those out to different departments or production processes based on those allocation bases. And I know this is very abstract, but I'll walk through exactly what this looks like. So the first allocation example we're going to look at, I'm just going to jump out of my slideshow here. So I've got it right here. So we've got network systems offering telecommunications, design and consulting services. And they have two different types of contracts. They've got a cost plus 25% contract that they could assign. So, like, hey, this client, this is the cost for the client. Take that cost, multiply it times 1.25, and that will be what we will charge them. Or we can charge them just like a flat upfront fee where we assign it upfront. So, when we do cost plus contract, the total cost that we use to figure out what that is includes the direct costs and the indirect overhead costs. So direct costs are things like labor costs, identifiable labor costs, and identifiable materials. And then the indirect overheads would be all the other costs that kind of get lumped in that we want to prorate out. So we've got this company completing 10 cost plus contracts. And a total direct cost of $450,000 and 15 fixed fee contracts. So revenues collected are 2.4 million for those two. Okay. Total direct cost of the fixed fee contracts was 75% of the collected revenues, and they had indirect overhead of $350,000. Okay, so we need to figure out then how to allocate this overhead of $350,000. But first we need to figure out like what did we have in terms of direct costs here. Okay, so direct cost of the fixed fee contracts was 75%. Okay, all right. So looking at this, I'm just going to lay out here then what were the direct costs for each of the different contract types. And I'm going to lay that out here for both the fixed cost contracts or the fixed fee contracts and for the cost plus contracts. And I'll come up with a total here, right? So the direct costs here, and they told us that all right, so as far as our direct cost, the total cost includes the direct costs and the indirect. Okay, so we had 10 contracts at a direct total cost of $450,000 for these ones. Okay, and 15 fixed fee contracts. Revenues collected from the fixed fee contracts totaled, okay, so that's revenues. We don't want to mix up our costs and our revenues here. All right, so I can kind of ignore it. Oh, wait, let's see. Total direct costs, 75% of revenues. Okay, so this one, the fixed fee is going to be 75% or 0.75 times the total revenues of 2.4 million. Okay, so 1.8 million here. Okay, so then in total between the two here, Our total direct costs were $2.25 million. And so in terms of these, right, let's figure out what percentage each of these incurred, okay? So this one is going to be 1.8 million divided by the 2,250,000. And I gotta make that, I gotta allow a decimal here. Okay, so 80% there. All right, and then okay, so in terms of direct identifiable costs for each of these, um, the fixed fee contracts incurred 80% of the direct costs, and the cost plus contracts incurred 20%. All right. Now, and then in terms of overhead, we had total overhead of $350,000, and they're saying that they assign that based on the percentage of direct costs. All right. So using the direct cost then as the overhead allocation base, we're going to take that $350,000 and multiply it and assign 80% of it to fixed fee. All right, so then that gets us to 280,000 of overhead assigned to the fixed fee contracts and $70,000 for the cost plus. So that means that the total amount that we have in terms of costs for each of these is 2,080,000 and 520,000 for the cost plus. So then we can figure out here, like they told us what the revenues would be, by the way, here was 2.4 million. They gave that to us in the problem, and then they said this one's going to be cost plus. So we would take that cost and multiply it times 1.25. They don't ask us to do this in the problem, by the way. I'm just doing it so that we can see what we would expect to have. So then that would give us a total of 3,050,000, right? In terms of revenue. Okay. Let's see. So in terms of allocating those based on the direct cost as the overhead allocation base, that's what we would go for. Now, here they want us to use number of contracts as the allocation base. Okay. So so what they're doing here is they're calculating what is referred to as an overhead allocation rate. Okay. And so to calculate an overhead allocation rate, typically what you do is you're going to take the total budgeted costs and you're going to divide it by the total allocation units. All right. And that's going to get you an allocation rate. Okay. So in this case, we have total expected costs here in terms of overhead, because this is what we're allocating here, right? This overhead cost. So we've got $350,000 here. That's going to be our total budgeted cost. And we're going to take that and we're going to divide it by the total number of contracts. Okay, so looking at this, I'm just going to label this percentage of direct cost here, right? Okay, so we had 10 cost plus contracts here and 15 fixed fee contracts. So total of 25 contracts. So then if we're going to take this $350,000, we're going to divide it by the 25 here, which is going to give us a rate of $14,000 per contract. Okay, so then the number, the overhead allocated based on the number of contracts is going to be 15 times 14,000. And if we add those up again, just to double check, that gives us the total of 350,000. Okay, so always double check that you did get everything allocated there, right? So this is for part B here. And then now let's consider this, right? So here we are allocating like basically 4-to-1 here. Looking at what percentage of this here is getting allocated. I'm just for funsies, I'm just figuring this out, right? So 60% and 40%, it looks like. Whereas up here, we're doing 80-20%. Now, so this is based on the number of contracts. Why, which one ends up working better? Well, you could make arguments back and forth as to which one you think it should be, but which one drives the cost better? Which one actually drives the increase in cost is probably the biggest question you want to ask here. So does the number of contracts drive the direct costs, or does the dollars of direct costs drive the cost? So let's see here. In terms of direct costs, which one? I'm curious how much the direct cost is per item here. Or I'm sorry, I'm looking at direct costs as a percentage of revenue here. So let's see, 450,000 divided by. So these are both, so the direct costs as a percentage here are pretty relatively, I'm sorry, per revenue. So let's see this. Okay. So to me, it looks like dollars in terms of like percentage wise here. The direct costs as a percentage of revenue seem much closer to me than the direct costs per contract. So that could actually be an argument that says that the dollars of revenue actually more accurately predicts potentially what the overall costs are for the project. Um, let's see. Yeah, because the total cost, we can't really do it by total cost because this total cost number we have up here includes the overhead. So I would actually argue that the percentage of direct costs method might actually be the more accurate method because it actually, hold on, let's see what percentage of revenue is it here. Wait, let's see. So 80/20 is pretty closest in terms of the revenue also. So probably the dollars actually is closest for me. Or let's see. So if this was on a per contract basis, it was it came out 60/40, right? So mhm, yeah. So I would probably go with the per revenue just because the costs, it seems to allocate it more closely to in terms of the amount of revenue that you have for each type of product. But I would want to see more numbers in order to back that up. But that's so basically what you want to look for is what is actually most closely relating in terms of like which changes along with the changes in the overhead costs. And that will tell you which one you should be using. Okay. Recording in So another example of allocating expenses out that they have in the text, and again, this is out there, but I just want to walk through it just because I feel like sometimes talking through it helps besides just reading it. So we've got Fitzhugh Investors, and they operate three mutual funds, and each fund has a schedule of fees that get charged for services, and they get all of their revenues from two different kinds of fees. First is based on the assets in the fund, and the second is based on the number of accounts. And so they make both of those in all three sets of funds. Okay. So, and they ask us to put together an income statement here to show the expenses and allocated other overhead. So I am going to include, because this is an income statement, I'm going to include a column for each of these. I'm going to put MM for money market. Okay, and then in terms of revenues, they've got the asset-based fees, per account fees. And okay, so if we have asset-based fees here for the money market, they're based it's 0.75%, so 0.0075 times the net assets in millions. And because these are in millions, this is in billions, right? So 1,050 million is 1,050 million, right? Okay. And then for the blue chips, they have 0.0175 times. There we go. And I can already tell I'm going to need to put those commas in there. All right. And then for the fixed, their asset-based fees are 0.0125 times 1824. There we go. And we'll just sum that up here. Let me just do this here. Drag this down to wherever so I don't have to deal with it again. There we go. All right. So, and then for the per account fees, it's going to be 25 times 275,000. That one, $8 times 110,000 and $9 times 185,000. All right, so total revenues. And that is our revenues here for this company. All right. Now, in terms of expenses, Um, each fund is operated as a separate line of business with avoidable direct expenses for sales and administration, fund management, transfer agency functions. Okay, so transfer agencies incur brokerage fees, maintaining customer accounts, and safekeeping securities. Okay. Now, the funds employ several common corporate resources. So things that are used by all of them as a group, including their website, computers, telephone reps, security analysts, and other things. So those would all be considered then um, um, I'm just put total line of business expenses. And then in addition to those line of business expenses, so the revenues minus those would be our gross profit, which is kind of like our cost of goods sold, right? So, and then we're going to have our corporate overhead expenses down here. All right. So, and these, I can just plug these in. Assuming I didn't make any typos here, I guess we'll find out, right? Equals B30 minus B36. Okay. All right. So those are all the givens that they've provided for us now. Let's see. So we allocate corporate expenses to respective funds based on the number of accounts. Okay. So I'm just going to put this here. Number of accounts. Which we had was 275,000. And so our unit of allocation then is number of accounts. So we're going to need to know in total how many do we have. Okay, so 570,000 total accounts. And corporate expenses total 2595. 2,595,000 here, and we're going to allocate them based on the number of accounts. So let's figure out then. So we're going to figure out what percentage gets allocated here by figuring out B26 divided by E26. And I'll put this $E $26 so that I can drag this over here. All right, and if I sum these up, it should equal 1. All right, and it does. Okay, so then we're going to allocate this by taking that percentage. So the rate to assign it, the other alternative is to use the predetermined overhead rate, where we would take the number or the amount of the budgeted expense here and divide it by the 570,000 accounts, right? Which gives us 4.552632 per account. we multiply that times the number of accounts for each of these, and if I highlight this, it's giving me my total of 2595000. So I can see that that ties out correctly. So that is what I come up with. And then so this is what it would be allocated at. In real life, they would probably be rounding it to the nearest thousand or something. Did they say anything about rounding on there? Closing any one fund could avoid 125,000. Okay. All right. Well, we'll just leave this as it is then. So then this gets us to net income here of, wow, lots and lots of income on the blue chips and losing money on the other two. Interesting set of financials there. All right. So that's the sample income statement that I would come up with. And they're saying some of the funds are reporting a loss. What actions should management take? Well, okay, so let's think about this, right? We've got money market funds, blue chip funds, and fixed income funds. Probably what they want to do is actually consider whether this is the right allocation method, if doing it based on the number of accounts is appropriate, or if it should be done. Another potential method that they could do is to allocate it based on net assets. So I'm going to take these numbers here and I'm going to copy them down below. And this is based on per account allocation, right? What if instead of doing that, we allocate this based on the net assets here? So let's do this. Let's put, I'm going to move this up here. So for net assets, I can leave the zeros off. It'll be the same proportion either way. So if we have 4,024, let's take that same amount here. So this one is per account. So if we allocate this per account, we're going to take that 2595000 and divide it by 4024. Okay. That'll be our rate here. And then we're going to take this and we're going to multiply the net assets we have here times that new rate that we calculated. And so if we do it that way, highlighting that, it's still our correct total of 2595. So that ties out. And actually, so this one ends up losing less. This one ends up losing more. Really, the problem actually seems to be up here because we've got negative gross profit up here. So it may not even be the overhead that's the issue here, right? Either one of these gets us to kind of the same boat in terms of how we allocate it. So I would actually look back at how these sales and administration costs are allocated up here. We see kind of a big difference here from the transfer agency. They just gave us those, the transfer agency ones. It doesn't say how those are allocated, but I think they need to consider how they're allocating these costs up here more closely because the amount of revenue that they're generating, the fixed ones generate the most and the blue chips the next. So theoretically, you'd think that at least the blue chip would have more expense, but this is like more than almost twice as much in expenses. And so maybe this one is closer to being right, but seems out of whack how much they're assigning here in terms of both sales administration and also in particular these transfer agency fees. So I would maybe consider taking those transfer agency fees and including those in the corporate overhead expense, and allocating those ratably also. That might solve their out of whack numbers here a little bit. Just an idea. Okay, so those were the things that I wanted to walk through from chapter 7. I will post another video with some items from chapter 8.